The National Bureau of Statistics announced in April 2023 that Nigeria's headline inflation rate had increased to 22.22% on a year-on-year basis. Inflation is a sustained increase in the average price of goods and services over time. It isn't just a general increase in prices, it is also a decrease in the purchasing power of money. While moderate inflation is considered healthy for an economy, high or unpredictable inflation is a major economic problem that can have a negative impact on both the economy and financial markets. Nigeria has experienced its fair share of inflationary pressures, which have had a profound impact on its economic stability and financial sector. Several factors like excessive money supply, rising production costs, high government spending, fluctuating exchange rates, inadequate infrastructure, and insecurity contribute to inflation in the Nigerian economy. Nigeria heavily relies on oil exports, making it susceptible to fluctuations in global oil prices. Volatile oil prices can lead to foreign exchange shortages, which in turn affect import prices and exacerbate inflationary pressure. Below are highlights of the detrimental effects of high inflation on various aspects of the economy. Reduced purchasing power. High inflation erodes the purchasing power of money and consumers. As prices rise, individuals have to spend more money to purchase the same quantity of goods and services. This reduction in purchasing power affects the standard of living for ordinary Nigerians, especially those with fixed incomes or low wages. Increased interest rates. In an effort to combat inflation, the central bank typically raises interest rates. This can make it more expensive for businesses to borrow money, which can lead to a decrease in investment and economic growth. Diminished business confidence. Inflation undermines business confidence and investment. When prices rise rapidly and unpredictably, businesses struggle to plan for the future and make long-term investments. This leads to decreased productivity, lower job creation, and economic stagnation. Income redistribution. Inflation can cause a redistribution of income within society. Those who have access to assets that appreciate faster than inflation, such as real estate or stocks, may benefit. On the other hand, individuals with fixed incomes or savings in cash lose purchasing power, widening the wealth gap. Reduced foreign investments. Inflationary pressures can deter foreign investors. The uncertain business environment and eroding purchasing power make investments less attractive. Reduced foreign investment limits economic growth, hinders job creation, and affects the overall development of the country. In addition to the negative effects that inflation has on the economy, it can also have a negative impact on financial markets. Under this section are highlights of how inflation impacts financial markets. Volatile interest rates. In response to inflation, central banks often raise interest rates to control the money supply and curb rising prices. While higher interest rates help combat inflation, they can also increase borrowing costs for businesses and individuals. This can slow down economic activity and negatively impact the profitability of companies. Stock market volatility. Inflation can introduce volatility into the stock market. Companies may face rising production costs, impacting their profitability. Uncertainty about future prices and demand can lead to fluctuating stock prices, making it challenging for investors to make informed decisions. Currency depreciation. Inflation can lead to currency depreciation as higher prices erode the value of the national currency. A depreciating currency affects import costs, leading to higher prices for imported goods. This can contribute a trade imbalance as imports become more expensive, affecting Nigerians' balance of payments. To address inflationary pressures, the Nigerian government and monetary authorities can adopt a tightening monetary policy, fiscal discipline, diversification of the economy, improving infrastructure, better exchange rate policies, and effective communication. Inflation poses significant challenges to the Nigerian economy and financial markets. It erodes purchasing power, diminishes business confidence, and affects income distribution. The financial market experienced increased volatility, reduced real returns, and currency depreciation. To address these challenges, a combination of prudent monetary and fiscal policies, diversification of the economy, and investment in infrastructure is crucial. By implementing appropriate measures, Nigeria can mitigate the adverse effects of inflation and pave the way for sustained economic growth and stability.